This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the hidden forces shaping the 2026 housing market. We'll explore why the data doesn't support a market crash, how global macro events are keeping mortgage rates elevated, and the surging hidden holding costs that are quietly squeezing investors, buyers, and renters alike.
Yeah, there's a lot to unpack today.
There really is. Links and resources are in the description below. If you find this podcast helpful, please consider subscribing and help us reach our first 1,000 subscribers as we build a research-informed investing community.
So, before we dive into all the numbers, I want to set up this really bizarre contradiction that's happening right now.
Okay, let's hear it.
Right now, California is actually losing more residents than any other state in the country.
Right.
But at the exact same time, it is also home to the #1 boomtown in the entire U.S.
Wait, really? How is that even mathematically possible?
It sounds crazy, right? But today, we're cutting through all the noise. We're looking purely at the math of supply, demand, and, those hidden costs reshaping real estate for you, the everyday investor.
Yeah, because we really want to understand the reality of 2026 without all the internet hype.
Exactly. And to understand that whole California contradiction, we first have to dismantle the biggest narrative hanging over the entire market right now.
You mean the crash narrative?
Right. There is this persistent idea out there that we're just teetering on the edge of a massive 2008-style housing crash.
Oh, I see that sentiment everywhere. People are sitting on the sidelines hoarding cash, just completely convinced the bottom is about to fall out.
But when you actually pull up the hard data, that crash just isn't showing up in the real world.
Let's look at the actual numbers for a second, because they're fascinating. The median home price in the United States right now is $429,226. And the most important part of that number is that it's actually up 0.9% year over year.
Which is such a critical detail, right? During the last major housing crisis, we watched median home prices plummet by roughly 30%.
Right, a massive drop.
Exactly. So seeing a nearly 1% increase is, it's the literal opposite of a crash. It's incredibly modest, sure, but it represents steady, stubborn growth.
And it really all boils down to supply. Right now, there are only about 1.7 million homes listed for sale.
Yeah, which is actually down slightly from a year ago.
Right. It's like waiting for a housing crash right now is like waiting for a massive clearance sale at a store that has almost zero inventory on the shelves.
That's a great way to put it.
You can't have a blowout sale if there's literally nothing in the back room to sell.
Exactly. To get a massive crash, you need a massive glut of supply. The basic laws of economics dictate that supply has to severely outweigh demand to force prices into a downward spiral.
And we simply don't have the inventory to trigger that.
No, we don't. Home builders just haven't been overbuilding like they did in the mid-2000s. Plus, current homeowners aren't giving up those incredibly low mortgage rates they locked in years ago.
I hear that, but I have to push back here for a second.
Sure.
I've been looking at the foreclosure data, and honestly, it kind of spooked me. We saw a 14% rise in foreclosures at the end of 2025.
Right, 14% number.
Yeah, a double-digit jump sounds like a massive red flag. Tell me why I shouldn't be panicking about a sudden flood of foreclosed supply hitting the market.
It's a completely understandable reaction, but we really have to look at the baseline of that 14% increase.
Okay.
It's a double-digit jump, yes, but on a very, very tiny number. When you do the raw math, total foreclosure activity right now is still lower than it was back in 2005.
Wow. So before the last crisis even started to accelerate.
Exactly. The absolute volume is still historically low, even with that percentage spike. And we also have to remember the mechanics of how a foreclosure actually impacts the market.
What do you mean?
It's just a painfully slow process. During the last crash, foreclosure activity started ticking up in 2005, but it took 5 full years to reach its peak.
Oh, wow.
Yeah, and home prices didn't actually hit rock bottom until 2012. It took a historic global financial meltdown to force prices down that far.
So what the data tells us for 2026 is that we're looking at a rather boring, flat year.
Precisely.
Which perfectly lines up with the major forecasts. Fannie Mae is forecasting a 1.3% increase in home prices. A recent Reuters poll of economists predicts 1.8% growth. And the National Association of Realtors is expecting somewhere between 2 and 3% growth.
So we're looking at flat to modest gains across the board. But, that flat growth creates a really strange environment.
Yeah, because if prices aren't crashing, why does the entire housing market feel so completely frozen? Like nobody is moving.
Right. And that's because it's not just about the supply of houses anymore. It's about the staggering cost of borrowing the money to buy them.
The mortgage rates.
Exactly. The 30-year fixed mortgage rate is basically stalled out right around the 6% mark, and it just stubbornly refuses to drop.
Which brings us to the macroeconomic side of the equation, right? Because mortgage rates don't just exist in a vacuum.
No, they are highly correlated to the 10-year Treasury note. Right now, the 10-year Treasury is sitting around 4.2%.
Which is wild.
It is. To give you some perspective, just a few years ago when everyone was getting mortgage rates at 3%, that 10-year Treasury was down around 1.4%.
I think a lot of people struggle to connect those two things.
Oh, definitely.
Everyday buyers tend to think local real estate is just this isolated pond. They think their home's value is purely about the local school district or, the new shopping center down the street.
Right, but local real estate is actually connected to the global ocean.
Exactly. It's like a seesaw. When someone drops a boulder in the water overseas, like a geopolitical conflict that spikes global oil prices, that tidal wave eventually crashes right into your neighborhood's mortgage rates.
That's the exact mechanism at play. Let's trace that tidal wave for a second.
Walk me through it.
When global conflict breaks out, the price of oil generally surges. When oil goes up, it costs more to manufacture and transport almost every single good on the planet.
Which obviously drives up inflation.
Exactly. On top of that, governments often have to print money to fund these expensive conflicts.
And printing more money dilutes the currency, which just pours gasoline on the inflation fire.
Precisely. Now, put yourself in the shoes of an institutional investor.
Okay.
If you're going to lend your money to the U.S. government for 10 years by buying a treasury note and you see inflation rising, you're going to demand a higher interest rate to protect your capital.
Right. You need a higher return just to break even on your purchasing power.
Exactly. So investors demand higher yields. The 10-year treasury rate goes up to 4.2%.
And because the Treasury is the baseline pulse for the entire borrowing economy, mortgage rates have no choice but to follow.
They get stuck at 6% because they physically cannot drop. The borrowing costs won't meaningfully ease until those larger macro pressures are resolved.
But here's the crazy part. Even if you buy a property in pure cash, or even if those ocean waves settle down and rates eventually drop, there's a completely separate current pulling property owners under.
The hidden holding costs.
Yes, it's the silent margin killer, the skyrocketing cost to simply maintain the asset once you actually own it.
It permanently alters the affordability equation.
It feels exactly like a sneaky subscription service.
That is a perfect analogy.
Like the base fee, your actual mortgage payment might be locked in safely on a 30-year fixed rate. But the mandatory service fees, which are your property insurance and your property taxes, just keep doubling.
And the data on those holding costs is just staggering. Since 2019, property insurance costs across the country have surged by 72%.
Wait, 72%?
Yes. And property taxes are up 31% in that same window.
We really have to pause on that 72% insurance hike because it's vital to understand why that's happening. It's not just, corporate greed.
No, it's a really volatile mix of factors. You have more extreme weather events wiping out entire zip codes, plus the skyrocketing cost of the raw materials and labor needed to rebuild those homes.
And the reinsurance market, right?
Yes, the companies that insure the local insurance providers, they're jacking up their own rates to cover all this global risk.
And that 72% hike completely destroys a family's monthly budget.
It really does. There's this metric called the Home Affordability Index. A reading of 100 means that a family earning the median income can exactly afford a median-priced home.
Assuming a 20% down payment, right?
Right. And pre-pandemic, this index was sitting at a very healthy 160 to 170.
Wow. And right now, that index is hovering just barely over 100.
Meaning a median income family living paycheck to paycheck can barely scrape by to cover a standard home.
That is rough.
If their local government hikes property taxes or their insurance provider demands they put on a new roof to keep their policy, they are instantly underwater.
So what do?
We are seeing families forced to rely on credit cards or take early penalized withdrawals from their retirement accounts just to cover these sudden spikes in basic holding costs.
See, everyone obsesses over whether the Federal Reserve is going to drop interest rates by 0.25%. But insurance and taxes are the real margin killers permanently destroying cash flow.
Absolutely.
Now, if you're listening to this, you might be thinking, well, the math is terrible, so I'll just rent instead.
Which a lot of people are doing.
And renting absolutely makes sense if you plan to move in under 4 years. But if you think you're escaping these hidden holding costs by renting, you're missing a crucial piece of the puzzle.
Because landlords don't just absorb those costs, they inevitably pass them down to the renters. If an investor's property tax goes up 31% and their insurance goes up 72%, the monthly rent is going up the second that lease renews. There is no escaping the math.
But renters do have a breaking point. When that lease renewal comes back and it's completely unaffordable, they don't just sit there and complain.
No, they pack up their cars.
And that breaking point perfectly explains the California contradiction we started the show with. These intense financial pressures are completely redrawing the migration map of the United States.
People are voting with their feet. Let's look at where the capital and the population are actually moving.
Let's do it.
For years, Texas was the ultimate boom state, but the recent data shows migration there has basically stabilized into an equilibrium.
But the states people are actively fleeing are crystal clear.
Yep.
The top 3 states losing the most residents are Illinois at number 3, New York at number 2, and California at number 1.
And Los Angeles is specifically the #1 city in the entire country that people are abandoning.
Meanwhile, the top destination state overall remains Florida, even with their highly publicized insurance hurdles.
Right. But nested inside that data is what we can call the Sacramento anomaly.
This is the contradiction that just blew my mind.
That's fascinating.
California is bleeding more residents than any other state in the country. Yet, Sacramento is the #1 city in the entire U.S. that people are moving to.
Right.
How does a state lose the most people but host the biggest boomtown?
Because macro pressures always force hyperlocal solutions. It's a pure arbitrage play based on the search for affordability.
Make that make sense for me.
People are fleeing the extreme, unmanageable costs of coastal California places like Los Angeles and San Francisco. But many of them don't want to lose their high-paying coastal salaries.
Or their state benefits, or being close to family.
Exactly. They don't want to cross state lines, so they hunt for a localized discount inland.
Ah, okay.
If you keep your Los Angeles salary but move to Sacramento, you suddenly have massive purchasing power in that local market.
You get a huge discount on your cost of living, but your arrival pushes home prices up for the people already living in Sacramento.
It proves that capital will always flow toward affordability. You might not be able to control global oil prices or the 10-year Treasury yield, but you can control where you choose to deploy your capital or plant your roots.
Many investors are thinking through what this means for their own positioning. If this raised a question or perspective for you, feel free to share it in the comments.
So let's summarize the core signals we've covered today with a few key takeaways.
Sounds good.
First, a housing crash is simply not supported by the data. Supply remains incredibly constrained at just 1.7 million homes, and 2026 is projected to see flat to modest price growth.
Right.
Second, mortgage rates remain stuck around 6%, and this is directly tied to global inflation and rising 10-year Treasury yields. Until those macro issues resolve, borrowing costs won't meaningfully drop.
And the third point.
Third, the real crisis isn't purchase prices, it's the hidden holding costs. Property insurance is up 72%, and taxes are up 31% since 2019, silently squeezing both property owners and renters alike.
Yeah, that's huge.
And finally, these intense economic pressures are driving massive physical migration, pushing populations out of expensive coastal hubs and into localized, affordable areas, completely reshaping the real estate map.
Which leaves you with one final, provocative thought to ponder. If these hidden costs of taxes and insurance continue to compound at this aggressive rate, year after year, will the traditional starter home disappear entirely?
It's a scary thought.
Are we watching homeownership slowly turn into a strictly luxury asset class, reserved only for those who can afford the endless subscription fees? It's something every investor needs to carefully consider. Thanks for listening to the 15-Minute Investor.